Today we're going to talk about tax residency, specifically between Canada and the U.S. And where you're resident determines who gets to tax you on your worldwide income for tax purposes. So Canada and the U.S. have many similarities, but it's really the differences that count here. And there's lots of differences between Canadian and U.S. tax law. We'll talk about those shortly. The critical aspect is the IRS nor the CRA, the Internal Revenue Service in the U.S. or Canada Revenue Agency, they don't have to figure out what your facts are. You have to demonstrate what your facts are. So you're in control of those facts, and that's an important thing for you as we move forward on this subject. Why should you care about tax residency? Well, you should care because there's huge differences in taxation between Canada and the U.S. Both can be attractive, but also both can be unattractive. If you win the lottery in Canada and you're a Canadian tax resident, you don't pay any tax. If you win the lottery and you're a tax resident in the United States, it's fully taxable. In Canada, you get capital gains exemptions. There's no equivalent in the United States. If you own corporations in Canada and you're a U.S. tax resident, you have significant reporting obligations in the U.S. Those can be expensive. Conversely, the U.S. has tax rates that are much more attractive than in Canada. You hit the top marginal tax rate in Canada in most provinces at about $200,000, and the tax rates are pretty close to 50%. In the U.S., you have a top marginal tax rate of 37% on taxable income in excess of $600,000 U.S. That's significant. And if you happen to live in a state that doesn't have a state income tax, like Alaska, Washington, Wyoming, Texas, and Florida, that's your total tax. That's a huge difference in terms of taxes. So there's some very significant differences in tax treatment. For the most part, with personal taxation, it's lower in the U.S. That's not always true for everyone. Again, it depends on their specific facts. So we've talked about differences between Canada and U.S. taxation in terms of federal tax residency. One of the important differences between Canada and the U.S. is the states are not signatories to the Canada-U.S. tax treaty. So you could be a resident of Canada federally, but also be a resident of a U.S. state like California, Hawaii, or other states. That could result in you being subject to Canadian federal income tax, U.S. state income taxes, and Canadian provincial income taxes as well. So you need to figure out what your state tax residency is, especially if you already have a connection to a state where you own a home or are working or already have activities in. These are important facts to consider. So now we're going to talk about the way that tax residency is decided in the U.S., in Canada, and under the Canada-U.S. tax treaty's tiebreaker test. It's not based on your immigration status. People make the mistake oftentimes saying, hey, I've got this immigration status in the U.S. or in Canada, therefore I'm a resident or not a resident. You can be illegally present in either country and be a tax resident of that country. And the important thing here is that Canada and the U.S. have many similarities. But in terms of tax law, it's the differences that count. And Canada's tax law is very different in terms of determining residency. It's based on common law principles and say, where does a person, all the facts support where he lives? I say what happens is CRA throws a bunch of facts into a bowl, mixes them up, and says, it smells like they live here. Now that sounds kind of odd, but where their spouse is, where their driver's license is, where their children and dependents live, those are all relevant measures of tax residency for Canadian tax purposes. The U.S. is entirely different. It's objective, and that objective measure is based on certain specific tests. One is, are you a lawful permanent resident of the United States? Most people know that as, do you have a green card? Any green card counts. Even an expired green card constitutes lawful permanent residence. You can get that from the word that says permanent. It's lawful permanent resident. It either has to be formally abandoned or rescinded by a judge to actually have it stop being a resident of the United States. The other test for U.S. residency is what's called the substantial presence test. You know it better as the 183-day test. Did you spend over 183 days in the U.S.? An important thing there is any part of a day counts as a whole day. If you're a resident of both Canada under Canadian tax law and a resident of the U.S. under U.S. tax law, then you need to go to the Canada-U.S. tax treaty and what's called the tiebreaker test. The tiebreaker test is made of 5 elements to it. They go in mechanical order, so once the determination is made, the test is over. And the test is, the first one is permanent home. The second one is center of vital interest. The third is habitual abode. The fourth is citizenship. And the very last test, if you will, is called competent authority. And you have those 5 tests. They go in order, mechanical order. Once a determination is made, it stops. So the fact you may pass 4 of them, but you lose in the very first one, you'll never get a chance to explore those. So let's talk about it in order. The very first test is permanent home. Permanent home is the place that you have available that you actually live in. It's not a mailing address, but it can be a trailer or a yacht or a vacation home. Those all can count as a permanent home. The big question is, did you use it on a regular basis, and was it available to you essentially at your discretion? So you don't have to own the house. You don't have to be in the lease for the house. It can be a friend's place. It can be your parents' home. The question is, did you actually use it as a home? And we're not talking about going for the weekend at your parents' place for the cabin. It's that you spent time there on a regular basis. If you have a permanent home in both countries, then you need to go to the second test. But if you only have a permanent home in one country, then the test is over. The tiebreaker test stops. And wherever you have that permanent home, that's where you're resident. Now remember, you only got this place because under Canadian U.S. tax law, you are a resident of both countries under their respective laws. The tiebreaker test stops as soon as there's a determination. So if you only have one in one country, it's done. The second test is the center of vital interest. It's a 2-part test, personal and economic. The personal test is, where does your spouse live? Where do your dependents live? And spouse, that doesn't necessarily have to be someone you're married to, but someone who you have a relationship that's similar to a spouse. Dependents are those that require your support on a regular basis to be with. So where your spouse and dependents are, that's going to be where your center of vital interest personally is. The second part of the test is the economic test. Now this one's frequently misunderstood, saying where your assets are located. Fundamentally, this is, where do you show up for work? Now, if you're independently wealthy and you're not working, you're retired or any other circumstance, this becomes a much less clear determination. It's much clearer to do where you're saying, I work in San Diego, then your center of vital interest economically is in San Diego. But if you are not working and, like say, you're independently wealthy, you have substantial amount of wealth, then it becomes a lot less clear. Do you need to be at a certain location in order to hold shares of IBM or Apple? I don't think so. You can be anywhere in the world. Where your RSP is located doesn't determine where your center of vital interests are. It does not require your presence to be there. And so it's not determinative. Now, given it's a 2-part test, personal and economic, you need to, in order to have the test determinative, both tests, personal and economic, have to fall to the same country. So if your personal center of vital interest is in Canada, but economically it's in the U.S., that's not determinative. They both have to be in the same country. If they're not determinative, then we move to the third test, which is habitual abode. Now, habitual abode is never defined by the Canada-U.S. tax treaty. The best way I've ever heard it described, it's the 183-night test. Where did you sleep? And that makes sense. It's the place you're returning to is ideally what it's saying. But the 183-night test is, where do you sleep most nights? And it's not based on whether you're in San Diego or whether you're in Dallas or Seattle. All those days count as being days in the U.S. or nights in the U.S. And similarly in Canada too. Whether you're in Prince Albert, Prince George, Prince Rupert, they all count as days, nights in Canada. So the 183-night test sounds really simple, but the courts have said it's not good enough for you just to have a couple extra days in Canada. You need to show that there's a significant difference there. So having 183 nights in Canada, 182 nights in the U.S. will not tie break you back to Canada. it needs to be really clear and determinative. And in this respect, we'd say, over 200 nights in one country means that you're only 165 nights in the other country. That starts to say that's really different. 200 nights is not a statutory provision, it's not a term of the treaty, but we recommend people saying, make sure you're spending at least a couple hundred nights in the country you want to tie break to if you think you're at risk for doing that. So the third test, habitual abode, if it's not a determinative test, the next test is citizenship. And citizenship is based on where you're a citizen. If you're a citizen of both Canada and the U.S., well, the test will not be determinative. If you're a citizen of neither Canada and the U.S., again, the test is not determinative. If you're a citizen of only one of those two countries, and the other three preceding tests were not determinative, then your residency is based on your citizenship. If none of the first four tests have been determinative, then the last one is something called competent authority. This is where the Internal Revenue Service and Canada Revenue Agency sit across the table from each other and saying, who wants you as their tax resident so they can tax you on your worldwide income? This is really bad news because there's a great deal of uncertainty as to what the result is going to be, and it's probably going to take several years for determination to be made. So clearly what you want to do as any taxpayer, as any tax advisor would tell you, is saying you want to be in a position where one of those first four tests are determinative, and ideally the determinative test gives you the determination you want, because remember, these go in order 1 through 5, and if none of those first four are determinative, you're back at competent authority, and that is not good news for you as the taxpayer. In the meantime, while you're waiting for a result from competent authority, you've got tax authorities in both Canada and the U.S. trying to tax you on your worldwide income, and maybe without offsetting tax credits to reduce your tax liability. You've got a great deal of uncertainty and no certainty about the result. So here's the summary. If you're a resident of Canada under Canadian tax law and of the U.S. under U.S. tax law, you need to go to the tax treaty's tiebreaker test. And the tiebreaker test that we've talked about has 5 elements in it. Once there's a determination, it stops, and they go in order: permanent home, center of vital interest, habitual abode, citizenship, and lastly, and the one you really want to avoid, is competent authority. And one of those 5 tests will make a determination in order for you. You want to control that result. You want to be in a position saying, I have the facts that support a determination in your favor, whether you want to be a resident of Canada or a resident of the United States. Taxpayers control the facts, and you're going to be the person that has to say, here's what the facts are. So it's critically important that you plan with that in mind and have advice that gives you that result that you want to achieve. Because the tax differences between Canada and the U.S. can be quite severe. And while there's a lot of things that are similar between Canada and the U.S., it's the differences that count. Whether you use our services or some other cross-border tax professional, I encourage you to get advice on this subject before you take actions which could have adverse tax results to you, or you lose the opportunity to take actions which could positively affect the outcome.